latecomers after every 5 minutes, not immediately. So somebody can just be posting in the group. Anybody who comes late, I'll be admitting them later on, because the way I want to set this, I'll have a full screen. So if I have a full screen, I don't see what is going on in the background. So every 5 minutes, I'll be checking and admitting new people so that you can see a full screen of what I'm doing. So without taking much time, let us start. So I want us to continue from where we had stopped in the physical class. Remember, we were on consolidated income statement. We looked at all the rules of consolidation. So somebody just to post, help me manage the group in class. The group, I'll be admitting latecomers every 5 minutes, not every 1 minute, because the class is too big to handle. So we were on income statement. We were on income statement, and we said that the rules of income statement, you consolidate as if you own everything. Maybe if I go back, but I don't want to go too much back because we'll take a lot of time. So we said, when consolidating the income statement, consolidate as if you own everything on a line by line basis. And then we said, add the income statement of the parent plus the income statement of the subsidiary, and then later on show what you'd not own. We did a number of examples, actually around four or so examples. Actually, there were 5 examples if you include the past paper. I think we did the June 2018 or December 2018 past paper question. So today we want to move a step further. Now, in financial reporting, please, when coming for the class, revise what we covered in the previous class. Because if you forget what we covered in the previous class, it becomes very difficult to continue. Because it's a continuation, it's like a series. It continues what we covered in the previous class, it relates to the next class. So always make an attempt to attend all classes. So I just want to straight away now move to what we are to cover today. So we want to look at an income statement, but a part called acquisition pathway through the year. Acquisition pathway through the year. Now, what is acquisition pathway through the year? This is where, for example, if our accounting year runs from January to December, and then a company is acquired maybe in May. A subsidiary is acquired in May. What does that mean? The subsidiary is acquired during the year. So if our balance sheet ends 31st December 2021, and a company was acquired on 1st June 2021, it means that company was acquired during the year. That is what we want to look at here. Always read exams questions carefully to know when was the company acquired. In the examples we covered in the class, those who are there in the class, we looked at when a company is acquired in incorporation, on the day it was incorporated, on the day it was registered with RDB. A company is registered and immediately it's acquired. That was our first example. Another example, we looked at where a company is registered, it operates for several years, and then it is acquired. And then we also looked at where a company is acquired at the beginning of the year. Those were the examples we looked at. So today we are looking at when a company is acquired during the year. Now, what are the rules that we follow when acquisition is during the year? So when the acquisition is during the year, first of all, you only consolidate the post-acquisition period. So the rule of the income statement, you don't consolidate the whole subsidiary. If a subsidiary is acquired during the year, you divide the subsidiary's income statement into 2. The pre-acquisition period and the post-acquisition period. So you divide the income statement into 2 parts, the pre-acquisition period and the post-acquisition period. So the rule is you only consolidate post-acquisition. Only consolidate post-acquisition. Don't consolidate pre-acquisition. So you divide the income statement into two, the pre part and the post part. There will always be a statement in the exam question that you assume that profits are accrued evenly. You assume that profits are accrued evenly during the year. That statement allows you to divide the income statement into two. So when you see the statement, assume that profits have been accrued evenly during the year, that is a statement that allows you to share the profits into two parts, the pre-acquisition and the post-acquisition. So as we prepare ourselves, there are two questions I want to look at. I want to look at June 2017 question 2, and I also want to look at example 6 in the notes. June 2017, those are the questions on, remember, every consolidation question is always not the same in exams. There is something new they are testing, especially on the dates and also on the nature of acquisition. So the questions are never the same. Every question tests something new. So June 2017 question 2, and we'll also look at example 6 in our notes. So I think I can start with example 6 is in our notes as we gain the momentum to start. Please let's learn to join classes in good time next time. So let's look at June, example 6 in our notes. If you have your notes, you go to page, I think I'm using slides. I'm trying to refer to the page of the notes. If you have your notes, go to page what?
25.
Page 25, thank you. Page 25, okay. Yes, acquisition, it's under. So whenever I'm covering a topic, I'm looking at the examples under that topic. So yes, thank you, it's page 25. So acquisition partway through the year. The explanation starts in page 24, but the question is in page 25. Let us learn to interact with our notes. So the question reads, P company, remember this question is preparing us for a past paper question. So P company acquired 60% of the equity of S company. Take note of the date, on 1st April 20x5. The income statement of the two companies for the year 31st December 2005 are set out below. I'm just reading it as 2005, but I know it is 20x5. Okay, so you have been given the income statement of the parent and the income statement of the, sorry, I'm losing my voice. Yesterday I taught almost the whole day, but I'll gain it with time. Don't worry about that. So the income statement of the parent and the income statement of the subsidiary. Now, required, prepare the consolidated income statement and movement on and movement. Now, take note of this. Then 20. Okay, the year ends 31st December 20x5, and the acquisition April 1st April 20x5. Look at this. If the year ends 31st December 20x5 and the acquisition was on 1st April, which means there is the January, February, March. Those months were months before acquisition. They are January, February, March. And then we acquired on 1st April. So from April to December, those are 9 months. So how many months are pre? 3 months. How many months are post acquisition? 9 months. So this income statement of the subsidiary will be divided into two parts, the pre and the post. So the first rule is to divide into pre and post. Divide into pre and post. Divide into pre and post. Whenever you see the slides go off, I'm just admitting new members. Okay, so we have that. So let's go to Excel and solve it. This is June 2017. We're doing it next. Let's go first of all to example 6. So this is the question you have said. So what you have said, the first thing is this income statement of the subsidiary, the one I've highlighted there. The income statement of the subsidiary is divided into pre and post. You only consolidate the post. So only consolidate the post. So let's get the post PS company. Post S, remember it is the subsidiary which is divided. Post S company. The advantage of online classes is that I use Excel, and therefore I'll be a bit fast. So these 80,000 times into bracket 9/12. Why 9/12? 9/12 is the post. 9 months out of 12 was the post period. So which means out of 80,000, 60,000 is post revenue and 20,000 is pre. We only consolidate the post. That is why I'm interested in only the posts. So you can see what I've done. This is the advantage of now online. I've just scrolled and it has calculated for me everything. So which means for the cost of sales, the post's cost of sales is 27. For admin, post is 9 until the end. So what is the rule? As we start, the rule is consolidate only post. So what is the name of the company? P. So we'll call it P Group Consolidated income statement for the year ended 31st December 20x5. For the year ended 31st December 20x5. For the year, Seba James, kindly switch off your video. Seba, kindly switch off video. You know, when we started the class today, there is somebody who was putting on the video. And that is the end of the story. We saw, okay. So always when joining the class, switch off your video. Okay. So we'll start with, when we are consolidating, I'll start with the revenue. Look at what I'm doing. Revenue. Now, when I'm consolidating, I'll take revenue of the parent is 170 plus 60 of the subsidiary. We don't take 80. We only take the post of the subsidiary. So it is 170,000 plus 60 of the subsidiary. Of course, I'll use bracket to show that it's a calculation I'm doing. So that gives you 170 plus 60 of the subsidiary. It gives you 230. We next go to cost of sales. In our cost of sales, we also do the same. 65 of the parent, 65,000 of the parent plus 27,000 of the subsidiary. So that is 65,000 cost of sales of the parent plus 27,000 cost of sales of the subsidiary. It gives you 92,000. We go to gross profit. Gross profit is an answer. You know what I mean by an answer? I explained that in our physical class. So 230 minus 92, it gives you the gross profit. So gross
Excuse
profit,
me.
yes.
Can you again explain why we use post consolidation instead of use pre-consolidation?
Because we acquired the company, during the year. The income statement after we acquired the subsidiary. After we must split the entire income statement of the subsidiary between pre-acquisition and post-acquisition proportions, and only the post-acquisition figures are included in the income statement. When do we do that? When acquisition is partway through the year. When you acquire the subsidiary during the year, you are preparing its income statement. So you only consolidate the post income statement. You don't consolidate the pre-income statement when acquisition is during. Is it
Yes.
admin expenses, administration expenses? So that's why it's important to always check the dates. Administration expenses, we have 43,000 plus 9,000. It gives you 52. And then we have profit before tax. Profit before tax. So our profit before tax is, of course, gross profit minus our admin expenses. It is 86,000. So our profit before tax is 6,000. Next, we have income. $20,000. So that is 3 plus 6. Profit for the year, the for the 86, 57 as our profit for the year, 57. Now, let me check if there are people who want to join. Okay. Now, once you get profit for the year, as we had agreed in the class, you divide that profit to profit attributable to. Profit in other words, profit that goes to the parent, to controlling interest. Profit to the parent and the profit that goes to the non-controlling interest. And then we have total profit for the year. You have your total profit for the year. So what is our total profit for the year? 57. You can see the 57 profit for the year, which we got from here. So profit for the year, that, let me, online you must have all your gadgets ready. Okay, let me use this marker. So we are saying this profit is the one you transfer down there. So that profit is what you done transfer down that. Okay, let's continue. So, and then after you've done that, you now go find out what goes to non-controlling interest. What goes to non-controlling interest is a profit for the year of post is 18,000. 18,000 times we acquired 60%. How much did we not acquire? 40%. Times 40%. So what goes to the non-controlling interest is 18,000 times 40%. So it is 7,200. What goes to the parent now becomes the balancing figure. What goes to the parent is a balancing figure. So what is our balancing figure? Our balancing figure is 57,000 minus 7,200. What does that give you? 57 minus 7,200. So that is our consolidated income statement. This example was just preparing us. The example was just preparing us. That gives you consolidated statement or consolidated income statement. But if you have been asked, you have been asked movement on retained earnings, what did we say last time? You get retained earnings brought forward. In other words, retained earnings at the beginning of the period. You add profit for the year, and then you get retained earnings carried forward. So what is our profit for the year? Our profit for the year is 49,800, the share of the parent. 49,800. Only you get the share of the parent. The share of the parent, this one here. The share of the parent. And then retained earnings brought forward. Let's be attentive here. You can see retained earnings brought forward there. These figures here. For the parent, it's 81. But the subsidiary, we don't pick it. Because at the beginning of the year, remember retained earnings brought forward. These are the retained earnings at the beginning of the year or beginning of the period. Beginning of the period, we did not have the subsidiary. I'm again repeating. At the beginning of the year, we did not have the subsidiary. Therefore, the profit that the subsidiary made at the beginning of the year was not our profit. I'm again repeating. When getting the movement, when acquisition is during the year, the subsidiary was acquired during the year. So the profit the subsidiary made in the previous years, that was not our profit. So the only retained earnings brought forward is the one of the parent, because the one of the subsidiary was not ours. The one of the subsidiary was made before we acquired the subsidiary. I hope that is clear. So 81,000 plus 49.
Excuse me, sir.
Yes.
So what if this company were acquired at the beginning of the year? How would you treat this?
Also, at the beginning of the year, you don't add, because it starts counting after the beginning of the year. Have you understood me?
Yes.
Do you see this? Retained earnings brought forward. This is retained earnings at the beginning of the year. So if the company was also acquired at the beginning of the year, you also don't add the brought forward, because the company was acquired at the beginning of the year, which means in the last year, the company was not there. Do you get me? These are profits that were made in the previous years up to the beginning of the year.
Okay.
30
Another
seconds.
question, sir.
Yes. When you ask a question, you say your name because I've disconnected all. I cannot see your faces. I've disconnected everything so that I have a full screen.
Okay, thank you. My name is Pascal.
Yes.
I would like to ask, is this means that we always take the retained earnings brought forward of the parent whenever we acquired at the beginning or during the year?
Yes, you only pick of the parent, and you are precisely correct there. You only pick retained earnings of the parent when you are getting the retained earnings at the beginning of the year, only under two conditions. Number one, acquisition was at the beginning of the year, or number two, acquisition was during the year. Number one, acquisition was at the beginning of the year, and number two, acquisition was during the year. That is why I say it's very important to note the dates. Look at this example we did in class. This example we did in class, example 3, the one we did in class. Okay, not maybe example 2. Yes, example 2. Look at this example 2 we did in class. The following information relates to Wheeler Group for the year ended 30th April 20x7. So note that this year is ending 30th April 20x7. I'm still on Pascal. Pascal, if this year is ending 30th April 20x7, when did that year start? May 20x6. Pascal, are we together?
We are together, sir.
Now, if the year started 30th April 20x7, come here and see what is written here. Wheeler Company purchased 80% of the issued share company of Brooks. In which year? 20x0. These are several years ago, almost 7 years before this date. Because it was 7 years, that's why if you see retained earnings brought forward, we took 460, and then we also took the 106, but we removed the pre. 56 was the pre. Why did we remove the pre? Because those are profits that were made before the company was acquired. Before the company was acquired. That was example 2 that we did. Example 1 that we did. If you remember this example 1, in example 1, P company acquired 75% of the ordinary shares of S company on the company's incorporation when the company was registered. Look at what we did in the movement. We took the whole profit of the parent plus the whole profit of the subsidiary, because the subsidiary was acquired on the date the subsidiary was registered. So all the profits of the subsidiary are post. Why are they post? Because the subsidiary was acquired immediately. It was. So I think those examples are enough. Let's go back. So this is example 6. We want to move on. So let's go to a past paper question. June 20, let me see, June 2017 question 2. June 2017 question 2. It is in page 170. If you have soft copy, page 170, you just click page 170. But if you have hard copy, just look for the June 2017 paper. I'm repeating, if it's soft, just type page 170, page 170. But if you have hard copy, look for the June in the hard copy. I've arranged the papers in order from the earliest exams to the latest exam. There are people interfering with us. Please don't make me mute you, please, because I may decide to mute you permanently and you'll not have a chance to ask a question. Okay, so let's go to whatever I'm saying now. So June 2017 question, I'm looking for question June 2017. Is it 2017? Yes, June 2017 question 2. Please, let's be attentive. If you have access to the question, you also read it. Now, I'll calculate this question into 2 phases. We are now only looking at income statement. So for now, I'll only concentrate on income statement. And then tomorrow, when we are in the physical class, when we have already started the balance sheet, again, I'll go back to the same question and cover the balance sheet in it. I hope we are together. So tomorrow in the physical class, again, the same question, but the balance sheet part of it to ensure it balances. So Gatanazi Limited is a trading company located in Kibuye in Karongi district in the West Province of Rwanda, and has been in operation for how many years? 12 years. This is the parent. In recent year, GL, remember GL, this one, GL is a parent. In recent year, GL has been acquiring humbly performing businesses and selling them at a substantial profit within a period of 2 to 3 years after their acquisition. On 1st July 2016, this is the first date you need to take note of. The first date you need to take note of. Which date? 1st July 2016, GL acquired 80%. I'm just taking note of the most important points. GL acquired 80% of the ordinary share capital of Ngonga Limited. So GL acquired 80% of Ngonga. Ngonga now is a subsidiary because it's 80% acquired, based in Ramagana at a cost of 534,560,000. Ignore that for now. We will use it in the after the break. These 5 when we have started the balance sheet. On the same date, it also acquired 50% of Ngonga Limited's 10% loan notes. I will also explain how we apply these loans also after the break. The summarized draft financial statements of both companies are as follows. Now look at the balance sheet date. What is the balance sheet date? 31st March 2017. When was the acquisition date? 1st July 2016. Does it qualify for the topic we are now covering? Is it acquisition during the year?
Yes.
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 It is acquisition during the year,
Yeah.
because end of year is 31st March 2017. It means beginning of the year is 1st April 2016. Beginning of this year is 1st April 2016. So how many months are pre? How many months are post?
It is 9 months.
9 months.
9 are post, 3 are pre. What are the 3 months that are pre? There is the April, there is the May, there is the June. So 3 months are pre, 9 months are post. What are we interested in? We are interested in post. Okay. So that means for this whole income statement, that is what we started by explaining when we started the class. For all these income statement of Ngonga, we will only consolidate what? Post. We will not consolidate pre. Why? Because acquisition was during the year. That is the subtopic where we are. Acquisition was during the year. So always when I choose past paper questions, I must only choose the past paper question that is relevant to the subtopic we are covering. Okay, let's continue. So that is Ngonga. So we'll have to divide these into pre and post. We only consolidate post because acquisition was during the year. I'm not interested in the balance sheet for now. So let's keep the balance sheet. We'll look at it after we have started the balance sheet. Additional information. Let's read all, but most of it is not relevant for the income statement. It's relevant for the balance sheet, but let's read everything. The fair value of Ngonga Limited's assets were equal to their book values, with the exception of its plant, which had a fair value of 166.4 million in excess of its book value at the date of acquisition. The remaining life of Ngonga's plants at the date of acquisition was 4 years, and this period has not changed as a result of the acquisition. Okay, let's continue. Depreciation of plant is on a straight line basis and charged to what?
The cost of sales.
Do we agree it affects the income statement? Cost of sales is found in the income statement. So
Yes.
of that, depreciation is charged to the cost of sales. We will take it to the cost of sales, so it affects the income statement we are preparing. Ngonga has not adjusted, therefore we need to adjust the value of its plant to its fair value. Let me explain now. When the parent, GL, I'm explaining that point one so that everyone understands. When the parent was acquiring the subsidiary, remember in class we said, whenever you are acquiring the subsidiary, you must value the subsidiary. You must value the subsidiary and ensure that the value that is shown in the balance sheet is the actual value that is the actual value of the company. Whenever you are acquiring a company, don't rely on what you have been given. Bring in your independent valuers to determine the value of the company. Now, when this company was being valued, let me admit new people. When this company was being valued, they found that the value was exactly the same as what was in the books, apart from only one item, with exception of what? Plant. So the value was the same as what was in the books, apart from only plant. Plant is in the factory, of course, you know that. Apart from only plant, whose value was higher by how much? Whose value was higher by 166.4 million, which means if the value of the plant, you see this plant, do we have plant in the balance sheet? No, everything has been summed up together. So which means plant is part of non-current assets. So which means non-current assets that were shown in the balance sheet had a value which was less by 166.4 million, because we found that the value, when we valued the plant, the value was 166.4 million higher. The value was higher by 166.4. So in other words, the plant in the balance sheet the value was understated. The value in the balance sheet was understated. We found that the value should increase by 164.4 million. Now, my question is, if, for example, your plant, I'm just guessing a value. If, for example, the value of your plant was 500 million, please understand the scenario I'm giving you. I'm guessing that. If the value in the balance sheet was 500 million, but we found that it was not supposed to be 500 million, it was supposed to be 666.4 million. Now, how have I got 666.4? Remember, I've guessed the 500 million is not there. I've just created it so that I explain. In the balance sheet, the value of the plant was 500 million. And then you found that it was understated by what? 166, which means the actual value was supposed to be 500 million plus 166. It gives you, I believe it gives you 666.4. Now, what do we mean? It means when you are calculating the value of the plant at the end of the year, in the balance sheet, you are calculating it based on 500 million instead of 666.4. What does that mean? When you are calculating depreciation, you are basing it on 500 million instead of basing depreciation on 666. What does that mean? It means depreciation was understated in the balance sheet. Do you understand the understatement?
Yes.
Yes. Why is it yes? Because when you are calculating, let us all mute once you have given a response. Because once you have given response, mute. It is because you calculated depreciation based on, especially those doing financial reporting and CPA for the first time. This is an important tricky point. You are calculating depreciation based on 500 instead of basing it on what? 666.4 million. So that means depreciation was what? Understated. It means depreciation was understated. So we need to correct that mistake of understatement. How do we correct that mistake? You take you take the 166.4 million. It was over 4 years. It was over 4 years. Where are the 4 years? I saw 4 years somewhere. The remaining life of all of Ngonga's plant at the date of acquisition was 4 years. So what you will do in that case, you will take this 166.4, you divide it by 4 so that you get the depreciation every year, because we were using straight line. You get depreciation every year. And then after you have got the depreciation every year, you only calculate 9 over 12 of it. 9 over 12. 9 over 12 of it. Why 9 over 12? Because we are only interested in post. Let's now go and read the others. I'll come back to that. In the post-acquisition period, GL sold goods to Ngonga at a price of 624 million. These goods had cost GL 468 million. I hope everyone was there in the last class. What I'm reading should be familiar. During the year, Ngonga Limited had sold 520 million at cost to Ngonga Limited of these goods for 780 million. Which topic is this? This is intercompany sales, where the parent or the subsidiary sells to, where the parent sells to the subsidiary or the subsidiary sells to the parent. I'll come back to that. GL bears almost all of the administration costs incurred on behalf of the group. It does not charge Ngonga Limited for the services, as to do so would not have material effect on the profit. So any service that GL offers, it does not charge Ngonga. Revenue and profits should be deemed to accrue evenly. This statement is what allows us to divide the income statement into two, pre and post. 9 over 12. Accrue what? Evenly. If it accrues evenly, it allows us to divide the income statement into two parts. The current accounts of the two companies were reconciled at the year end, with Ngonga Limited owing GL 39 million. This is called intercompany balances. I will explain it when I'm covering the balance sheet. Intercompany balances, when we are covering it after the break, we will see that it should be eliminated. It should be eliminated. Let us continue. The goodwill was reviewed for impairment. Where? Goodwill was reviewed for impairment at the end of the reporting period and has suffered an impairment loss. An impairment loss of 15.6 million, which is to be treated as what? Operating expenses. Operating expenses is also part of the income statement. So there is an impairment of goodwill, which should be treated as part of operating expenses. So it should be part of operating expenses. Next point, GL's opening retained earnings were that, and Gonga Limited's were 280. No dividends were paid or declared by either entity during the year. This means that this weekend we have a lot to learn, because all these points I must explain them during this weekend. It is the group's policy to value non-controlling interest at acquisition. Again, this will affect the balance sheet. I will explain it. The directors valued the non-controlling interest at 130 million. So that affects the balance sheet. So required 30 marks. What does the question ask? Prepare consolidated statement of profit or loss, this, and statement of financial position. After the break, we look at that. Statement of financial position for GL Group for the year ended 30th March 2017. Next, discuss the need to eliminate unrealized profits when preparing what? Group financial statements. Why should we eliminate unrealized profits when prepare? Why should we eliminate unrealized profit? Because this is profit that has not been earned. Remember, the rule we learned in class last time, we said, I'm discussing the theory part. We said that unrealized profit is profit that has not been earned by the group. We are only allowed to earn profits if the goods are sold to the third party. If the goods are not sold to the third party, we should eliminate the unrealized what? Profit. Profit on goods that are unsold is what is called unrealized. Profit on goods that are unsold is what is called unrealized. Sorry, I took a lot to explain the background, but it was important. So let's go and attempt the question now. So this is our question, and we want to start with GL. What was the name? Prepare the consolidated statement of profit or loss and statement for GL Group. So GL Group, and then you come and have consolidated statement of, is it which statement were we asked to prepare? Statement of profit or loss, statement of profit or loss for the year ended 31st March 2017. For the year ended 31st March 2017. For the year ended 31st March 2017. Please, next time, join class early. The people have just admitted now. Now, we have our income statement. Always ensure the solution is what comes first. We are working in, note that we are working in thousands, FRW 000. So you'll have your sales revenue. Next, we'll have you less what? Cost of sales. I'm just typing the income statement so that we save time to give you gross profit. After getting the gross profit, next we have operating expenses. After operating expenses, we have loan interest. This is tricky. Loan interest received stroke paid. So there are two interests there. There is interest that is received, which is an income, and there is interest that is paid, which is an expense. Take note of that. Profit before tax, income tax, of course, expense, We have profit for the year. And then after profit, please always guess the format you must follow it. After profit for the year, what did we say? Profit attributable to what goes to the parent and what goes to the non-controlling interest. We were not asked for movement, but and then this will give you total profit for the year. We were not asked for the movement, but if we were asked, I can add it there. Movement on retained earnings. I'm just putting everything so that when we start, we move fast. And then retained earnings at beginning, or retained earnings brought forward. And then we have profit, add profit for the year. I hope what I'm doing, everyone understands, because we covered it in the last classes. And then gives you retained earnings carried forward. Please, whether you understand additional information, now we are tackling an exam question. Whether you understand the additional information or you don't understand, please give the format based on the question. If you give the format, you can easily earn majority of the marks, because once you have given the format, and this is now when you're doing exams, once you have given the format, there are some free marks you will earn, especially marks on items that are not affected. Marks on items that were not affected by additional information. Those will be free marks that you should earn. Now, look at what we are doing now. Let's start with revenue. Now, when we are starting with revenue, I'll have my workings. And in my workings, I want my working one, because later on we'll be covering balance sheets. To save my time in the balance sheet, I'll have the dates. My first working, or should be listing the dates. What is the date of acquisition? Date of acquisition. You must note the date of acquisition. We learned it is 1st July 2016. 1st July 2016. What is the statement of financial position, or year end? Year end date. Our year end date is 31st March 2017. There is somebody affecting us with some echo. Let me look for him and mute him. Fredson, next time please mute yourself. Okay, so we have that date. So which means we have agreed, therefore, the acquisition was 3 months after the beginning of the, I'm also teaching using the same exam, using the past paper, so that's why I'm typing. Therefore, the acquisition was 3 months, so that when you are revising, you can follow. Therefore, the acquisition was 3 months after the beginning of the year. Pre-acquisition period was 3 months. That is 1st April to 30th June 2016, while post acquisition was 9 months. That is 1st July 2016 to 31st March 2017. What is my last point? Remember, these points are not, don't write them in exams. These are just, I'm using them to explain what you are to do, because I'll be sharing these. Now, only, what is the rule? Only consolidate post acquisition. Only consolidate post acquisition. Only consolidate post acquisition. So that is my point number 1. Working 2. Percentage of acquisition. What percentage was acquired? So we acquired 80% of ordinary share capital. What does that mean? Non-controlling interest is 20%, because we will use it somewhere. That is why I'm saying that. Okay, let us continue. Working 3. I hope you are understanding the step-by-step working. There is what we call fair value adjustment on plant. Fair value adjustment on plant. Whatever I had explained. Fair value adjustment on plant. Now, what did we say? At acquisition, you remember point number 1? If you have forgotten it, this one. The fair value of Ngonga's assets were equal to their book value with the exception of its plant, which had a remaining fair value of 160, which had a fair value of 166.4 million in excess of the. So what is the fair value? Fair value increase or adjustment in plant. In the plant, the value increased by, the fair value increments in plant was by 166,400 million. $166,400 million. Remaining life of asset was
4 years.
4 years. Remaining life was 4 years. So depreciation.
Straight line method.
Yes, straight line method. Depreciation using straight line. These notes will help you when you are revising. Allow me to take time, but I explain. Depreciation using straight line method. So depreciation was therefore how much? You will take 166.4 million divided by 4 years. Divide by 4 years. What does it give us? We want to, what am I trying to get? I'm trying to get the depreciation per year. So this is 160 divided by 4. So that gives you 41,600,000. 41,600,000. 41,600,000. But we are only interested in 9 months. Depreciation for 9 months, because we are only interested in post, in other words, post, is equals to 41.7 6M times 9 divided by 12. That is this, or is equals to this amount times 9 divided by 12. So it gives you that value there, 31. We will use those figures somewhere. So we are interested in that. We will use it somewhere. So let me highlight it that we are interested in it. I'm just highlighting it in a unique color to know that we'll be interested in it. So that is fair value adjustment. Working for. Let's read working for. I've forgotten it. Let's read it. There is here. Please, let's be attentive here. There are some hidden points. These additional information too. In the post-acquisition period, the question is very clear, post-acquisition. So this transaction took place in the post-acquisition period. In the post-acquisition period, GL sold goods to Ngonga. GL is the parent. The parent sold to the subsidiary at a price of 624 million. These goods had cost GL 468 million. During the year, Ngonga Limited sold goods worth, during the year, Ngonga Limited had sold 520 million at cost to Ngonga Limited of these goods for 780 million. First of all, the point there is intercompany sales of goods. Remember, sometimes there can be sale of non-current assets. So here we are very specific. Who sold? GL to Ngonga. Why are we interested in knowing that? In other words, parent to subsidiary. You will understand why it's very important when we are looking at balance sheet after the break. So intercompany sale of goods. Now, what was the amount of the sales? What was the sales? What was the sales? It is here. In the post-acquisition period, GL sold goods at a price of what?
624.
624. Okay, let me write it here. 624. I'm writing it in full so that we avoid confusion. Okay. Now, next, we are in this point here, this second paragraph. We need to continue with it. 624. These goods had cost GL. So GL is the seller. GL sold to Ngonga. These goods had cost GL what? So let's go get profit made by GL on sales. How much profit did they make? Look at this. 624M minus 468M. I'm trying to be slow there so that everyone gets it. So is equals to 624 million minus 468. 1, 2, 3. 1, 2, 3. Okay. So the profit made, remember that is not unrealized profit. Unrealized, out of this profit, there is the part that is realized and there is the part that is unrealized. Now, what is the realized part of this? Realized profit out of 156 is the profit on the goods that will be sold by Ngonga. Remember, GL has sold to Ngonga, who is a member of the group, and made a profit of 156 million. Now, out of this profit of 156 million, it is divided into two parts. The realized and unrealized. Unrealized is the profit on goods unsold by Ngonga, not GL, by Ngonga. Unrealized is profit on goods unsold by Ngonga. But now there is a tricky part here. Let's read it carefully. During the year, Ngonga Limited had sold 520 million at cost to Ngonga Limited of these goods for 7 to 80 million. There is some English there. Let's read it again. During the year, Ngonga Limited, remember Ngonga was the buyer, had sold 520 at cost to Ngonga. Ngonga is the buyer. So what is the cost to Ngonga between 624 million and 468? Can somebody answer me? What is the cost between 624 and 468 to Ngonga? What is the cost to Ngonga? Between these two figures, 624.
624. It is sweet 624.
It is 624. Because when Ngonga was receiving the goods, they received them at 624. So that is the cost to Ngonga. To GL, that is the sales. But to Ngonga, who is the receiver, that is at cost to Ngonga, it is 624. Now, during the year, Ngonga Limited had sold 520. So, unsold goods by Ngonga. What are the unsold goods by Ngonga? It is 624 million minus 520 million. That was an important point I wanted to bring out. So that gives you 624 minus 520. It gives you 104 million. Now, unrealized, we calculate. You don't need to do that in exams. We calculate unrealized profit, which is profit on unsold goods. You don't need to type that in exams. I'm just as follows. You don't need to do that in exams. As follows. So what will it be? Unrealized profit will be equals to 104 million divided by 104 is the unsold goods, unsold goods, divide by the total goods was 624 million. What am I trying to get there? I'm trying to get the percentage of goods unsold. Percentage of goods unsold times the profit, times the profit of 156. So that out of this profit of 156, we need to know what was unsold and what was unsold and what was sold. So what does that give us? It is good we are online. I can use calculators. We can use the formulas so that we are fast. It will be 104 divided by 624 times 156. So it gives you unrealized profit was 26. Now, remember, so as a summary, what is our sales? Our sales is therefore 624. Unrealized profit, realized profit is 26. Cost of sales. You remember what we said about cost of sales is a balancing figure. If you are there in the last physical class, cost of sales becomes a balancing figure. So 624 minus unrealized of 26, it leaves us with cost of sales of what? 598. Cost of sales, cost of sales and unrealized sales. Again, these you don't need to do in exams. Cost of sales and unrealized profit should be eliminated when consolidating. Should be eliminated when consolidating. I hope that is clear. Next point, I read also another point that affects the income statement, working 5. Let's read another statement. GL bears almost all that does not affect us. Revenue and profits are accumulated evenly. I've already explained that. Current accounts of the two companies were reconciled at the year end with G Limited owing GL 39 million. I will explain that. This is called intercompany balances, but we will not use it for now. Let me just put it there. Intercompany balances. So what the point I'll make, intercompany balances should be eliminated between parent and subsidiary. In other words, deducted from receivables and payables. I will explain that receivables and payable in statement of financial position. So I'll explain that when we are doing the statement of financial position, but it's good to note it so that we don't forget it. So it is how much? 39 million. So intercompany balances of 39 million. Intercompany balances of 39 million should be, that one affects, let me put there, affects only a balance sheet. So that when you are revising, you know it only affects the balance sheet. Let's continue. I'm trying to do everything to save time after the break. So GL's operating here.
Excuse me, can you repeat on the 39? How do you get them? The intercompany balance. Thank you.
It is point number 5. The current account of the two companies were reconciled at the year end with Ngonga Limited owing GL how much? 39 million. With Ngonga Limited owing GL, which means Ngonga owing GL means Ngonga had something they were supposed to pay GL. So Ngonga had a payables while GL had a receivables of 39 million. I'm again repeating, the current account of the two companies were reconciled at the year end with Ngonga Limited owing GL 39 million. Owing GL 39 million. So which means Ngonga was owing GL, which means Ngonga had some payables of 39 million, which was they were owing GL. And GL also had some receivables of 39 million, which they were being owed by Ngonga. So that is called intercompany balances. But let me not explain much on that because it is one of the subtopics I'll come back to. Intercompany balances. So I've explained intercompany balances deducted from what? Receivables and payables in the balance sheet. But remember, I'm very careful what I've said there. I've said intercompany balances should be eliminated between parent and subsidiary, but not eliminated, so that I'm just very clear, in associates. Later on, not this weekend, when we are covering associates, the rule is for the subsidiary we eliminate, but for associates we don't eliminate. Again, that point normally confuses. when people see intercompany balances, even if it affects associate, they eliminate it. The rule is you only eliminate of the subsidiary, but you don't eliminate of the associate. The reason is subsidiary is treated as a member of the group, but associate is not treated as a member of the group. We eliminate only for members of the group. We don't eliminate for outsiders. Outsiders are not treated as members of the group. That is the reasoning. Let's go to the last point.
Sorry, I have a question on point 4.
Point 4,
Yes. Is there any situation where we are not allowed, we are not authorized to divide the income statement by 2?
Yes. Under which circumstance? When acquisition is at the beginning of the year or previous years. When acquisition is at the beginning of the year or in the previous years, we are not allowed to divide. Have you understood me?
Yes.
Okay, let's continue. Okay, next point. Goodwill was reviewed for impairment at the end of the reporting period and has suffered an impairment loss of 15.6 million, which is to be treated as an operating expense. You agree operating expense is part of the income statement. So working 6.
Question, sir.
Yes. Ask.
I still have a confusion on working number 5. It means we will deduct that 39 million from payables of GL and still we deduct again from receivables of Ngoga.
Yes.
We will do both.
Yes.
Thank you.
Now, I'm even wondering how to ask this question. Now, you know, there is in financial accounting what is called double entry. You know double entry. Is that okay? For every transaction, there is a debit entry and a corresponding credit entry. Now, receivables in the balance sheet is an asset. Payables in the balance sheet is a liability. So you deduct it from the receivables, which is an asset, and also you deduct it from payables, which is a liability. That is double entry. Have I answered you?
Yes, sir.
Yes. Okay, fine, let's continue. Okay, fine. I thought you are asking another question. So impairment of goodwill. So goodwill impairment of how much? 15.6 million. Add another 0 of 15.6 million is to be treated as an operating expenses. So it goes to operating expenses. Goes to operating expenses. I hope you will remember that. I'm now done. Yes, I'm done. I was just confirming that I'm done with every working. So let's go to the revenue. Look at the points clearly. Revenue. Now, what is the revenue of the parent? It is 3,100,000. Look at what I'm doing. 3,120,000 plus 9/12 times 1,248,000. Why have I multiplied by 9 over 12? Because we are only taking the post. We are only taking the post minus intercompany sales. Intercompany sales. I'm looking for the point of intercompany. What is the intercompany sales? 624 million. Minus 624. 000 000. No. I'm removing 3 zeros. 624 million is the same as, if I remove 3 zeros, 624,000, so that we don't mix them up. We are working in thousands. I hope you've understood that working. So what is our answer? 3,120,000 plus into bracket 9 over 12 times 1,248,000 minus 624,000. What we get is 3 million. Whatever value we get there, we'll just write it. Let's go to cost of sales. The same treatment for cost of sales. So cost of sales, it is, again, let's be attentive under cost of sales. These brackets will confuse if I leave them like that. If I leave them like that, they will confuse you. I'm changing the brackets. Okay, cost of sales is 2,184,000 plus 9 over 12 times 1,040,000. I hope so far so good. Minus intercompany cost of sales. Intercompany cost of sales was this one here. Intercompany 598,000. You remove 3 zeros because we are working in thousands. Intercompany cost of sales is 598. 598,000. Please, we have not finished. And then there was fair value adjustment, depreciation undercharge. You remember the depreciation that was understated. Depreciation undercharge, you add undercharge, and you add depreciation undercharge. The depreciation that was understated, where was it? Under fair value adjustment. 31,200. 31,200. 31,200. Two 184,000 plus into bracket 9 over 12 times 1,040,000, close the bracket, minus 598,000 plus, you have said plus what? 31,200. 31, it gives you 2 million. So what is our gross profit? Gross profit is equals to sales minus that. It gives you 1 million and whatever value you get there, 1,034,000. Operating expenses, we repeat the same trend. You can see operating expenses is 312,000 and 10,400. 312,000 plus 9/12 times 10,400. Please remember there was another operating expenses. I've forgotten. I read it somewhere. There was another operating.
Excuse me, sir.
Yes.
Someone called Ganza is. Someone called.
Ganza has removed your screen. We can't see what you are doing.
Okay. Who is this Ganza? Okay, let me redo it.
He has shared some screen.
But I have a question.
Wait on the screen. Now he's making me to project what I didn't want to project.
Now it's okay.
Is it back?
Back.
Yeah, it has come back.
A question, sir.
Yes.
I wanted to know if those workings about to intercompany sales revenue and cost of sales. Is it a rule to be applied, or it is working in the question?
Which one? I'm not understanding your question. Repeat your question.
I'm asking on those intercompany balances about the revenues and the cost of sales in the intercompany. Is it a rule to be applied, or it is working in the question?
It must be eliminated. That is the rule.
Yeah.
It
To
must
use
be
to use it is to eliminate.
Yes, to remove it. Intercompany, but any working, you see, like this one. Thanks for raising that. This one is working. Where is it? It is working for. You see this one?
Yes.
This 624 is working.
Yes.
Working for.
Yes.
Is that okay?
Yes.
This 598 is working for.
Yes. Yes.
Are we there? And
yes.
this 31 is working.
3.
Working?
3.
You know, I believe in seeing.
Yes.
Because once I share with you this and it is wrong, you will say it is this lecturer who gave us fake things. So I must confirm. Okay. So here is, so I hope I've answered you.
I have a question.
Uh-huh.
On adjustment number 2, that figure 78 million stands for what?
Which 78 million?
78 million. On adjustment number 2.
Working.
Not in working, in the question.
He's asking on the question.
In
the question.
Any additional information.
This 780 million was put there to confuse you. But it is either so that they see if you use 780 million or if you use 624 million. That is the reason why it was put.
But it seems like is also the cost of goods. I don't know how can I.
No. Please, let's read it again. But it's a good question you have asked. In the post-acquisition period, GL sold to Ngonga Limited at a price of what?
624.
624. Are we together? At a price of 624.
Yes.
So remember, what should be eliminated is intercompany.
Yes.
The sales between the parent and the subsidiary, not what goes outside.
I understand.
780 is what goes outside. It is not
so much.
Intercompany.
Yes.
Okay, I hope you've understood it.
Yeah.
Okay. Whenever you have a question, please We are here to answer questions. So operating expenses I've taken of the parent.
I still have a question.
Yes, but let's again
about the cost of sales.
Yes.
This amount of impairment, is it to increase the cost or to reduce the cost? Because I see.
Okay, I've gotten you now. What is impairment? Loss in value. Do you agree?
Yes.
It is treated in the same way as depreciation. Now, if it is treated in the same way as depreciation, think of depreciation. What is depreciation? It's an expense. Does depreciation increase expenses or reduce expenses? Answer me. The person who has asked that question.
It increased the expenses.
Now, what is your question? Ask it
My
again.
question is that I see the plus, the signal of plus there.
Yes.
What I'm asking, it means that this amount, cost of sales. Cost of sales, we have to minus that amount of 59800 and plus. I don't know why this. I thought this also 312 will have a sign of negative.
No.
Increase.
You see, the answer is somebody has answered that. Number one, why have we minus 598? Because of the rule, intercompany sales should be eliminated. So we have minus because we are eliminating 598, just like 624 has been eliminated. Is that okay?
Yes.
But 31200, which is the impairment, it increases cost of sales. It is not to be eliminated.
Okay, I understand.
Increases cost of sales. I'm again repeating,
now.
whenever you have a question, ask. Don't,
okay, thank you.
Don't wait for the questions in exams. Okay, so 312. So there is another operating expenses before those questions came.
Pardon, please.
I pardon what?
That is 200 million is not about impairment, it's about depreciation.
It's about
depreciation.
31 what?
31,200,000.
It's about
depreciation.
Yes.
The cost of depreciation. We're not yet at impairment. Impairment is at.
I was just using impairment to explain. Remember, I said impairment just like depreciation. Did I make a statement like that? So we were explaining depreciation, and because I anticipated, I expected a question also on impairment. That is why I brought impairment in the explanation. Do you understand me?
Yes.
I expected that in future, somebody will ask me a question on impairment. That is why I made the statement impairment. I know it is depreciation. Is that okay? Now, that future question I'm talking about is now here with us. Look at this. Impairment of goodwill. It is 15,600. That is why I explained it before. Goodwill impairment is treated as operating 15,600.
Excuse me.
Now, you know, if we continue like that, we will not move.
Increase the size of screen.
If I increase it, it will be too big now. You are not seeing.
Seeing, sir.
No, we are seeing.
You know, if I increase it, it will be too big from my end. I'll be forced to.
The screen is okay.
It's okay.
Okay. Now he has even mixed.
I have a question.
Yes.
I have a question.
When you have a question, you say that and then you ask because of time. Ask your question.
On cost of sales. That one.
Your network is not clear. I think you will improve on it and then you ask your question later on. Your network is not clear, so we can't hear you. Please, let's move on. Eh? We are taking a lot of time now. Goodwill impairment is 15,600, and we have been told in the question it goes to operating expenses. So 15,600, it goes to operating expenses. So you'll add it. 15,600. Somebody remind me, it was working number?
Working number 6.
Working number 6. Working number 6. Now, this is what I was explaining to the other person. I didn't want to explain it twice. This impairment is treated in the same way as depreciation. That is why we have added it. I hope it's now clear to the other person who was asking. Now, what is this? It is 312,000 plus into bracket 9 divided by 12 times 10,400, close the bracket, plus 15,600. It gives you that. Please, let's be also attentive in the loan interest, because there is a confusion here. There is a loan interest received and there is a loan interest paid. You see there are two, received and paid. So let's carefully read it. Loan interest received, which is positive, and there is the loan interest what? Paid.
Negative.
Negative. Now, before we account for this negative, we must multiply it by 9/12. Because it affects what? Ngonga. And then, because it is more than this, we want to only remain with one figure. We expect, before I explain, let me just do it here. 10,400 times, I will remove that, times 9/12. What does it give you? 7,800. Do you see 7,800 is more than 3,900?
Yes.
So the negative of 7,800, which is 9/12 of 10,400, is more than the positive. So we need to get the difference between the two. There is the positive 3,900 and there is the negative 7,800. So which means the difference will be a negative. Do you get me? The difference between this and this will be a negative.
That's correct.
Is it correct?
Yes.
Yes.
Yeah.
So that is what I want to do. So 3,900. I'll start with the one that is negative because we are in an expense. So I'll take 9/12. I'll start with the one that is negative. 9/12 times, what was it? 10 what?
10,400.
400.
Okay. And then I remove the one that is positive because we realized, you know, Bodmers, we realized the one that was negative was bigger than the one that is positive. So what was the amount that was?
Sir, put 400, not 4,000.
Okay, thank you. It could have brought a problem. Minus 3,900 because the positive was smaller than the negative.
Yes.
So that gives you, look at this when I put it there, 9/12 times 10,400 minus 3,900. This 3,900, let's all agree it is negative.
Yes, it
But
is
because
negative.
it is now an expense. Remember, let me put there. It is an
Negative expense.
expense. If it was a received, I could have also written it there as received. So what is our profit before tax? It is gross profit minus operating expenses minus expense. But if it was income received, we could have added. Are we together?
Not
If it was
really.
income, we could have added. What I'm saying, 3,900 is an expense because it was a negative. Why was it a negative? Here, I go back here. Loan interest received stroke paid. The paid is 10,400. The received is 3,900. So you take 9 over 12 of 10,400, which is 7,800. We had already calculated it. So 7,800 is the expense. 3,900 is the income received. So the expense of 7,900, 800 is more than the income. So which means the difference between these two is an expense because the amount of expense is more than the amount of income. Expenses reduce profits. Income increase profits. Now, here, let me go
Excuse me,
back.
sir.
Yes?
If it is a 3,900 was a positive, okay? It will be income, it must be added.
Pardon? Yes, it must be added. Yes,
Okay,
it must be. Incomes increase profits. Expenses reduce profits. Okay, let's now, I think we are now done. The last one, income tax, 156 and 31,200. You know, if we don't manage, if I get questions from 100 people, we will only solve one question the whole class. Ask your question.
I have a question. Like here, when you are saying we are trying to consolidate. So if here to Ganza Limited, it was an income because it has a positive. How comes after consolidation it becomes a negative? I don't understand the logic.
Become a negative how?
Like according to the financial statement provided to the side of Gatanazi, it was a positive. And for the size of Ngoga, it was a negative. Then after consolidation, it becomes a negative. Yes, but for me, I don't understand the logic.
Logic nuko expenses ziruta income. No, bikaguma biri expense.
Now, I've understood you, but all costs, expenses are costs. All costs are normally deducted. You see, like here, cost of sales. You see cost of sales here. It's a cost. You can see in the question, it's written negative. Negative. Operating expenses, negative. Negative. Why have they written negative? Because it is deducted. When we come to loan interest received, let's all mute, please. So when we come to loan interest received, it is positive because it is an income. Incomes are positive if you check this. If you check this. But this other side, Ngonga, it is an expense. That is why they've said loan interest received stroke paid. So the 10,400 was what was paid. Then 3,900 is what was received. Now, when you take 9 over 12, yes?
I think you did not get me. So my question is, how comes a side of a subsidiary can affect the side of the parent? In other words, so it means if you have a negative side from the subsidiary, can affect your side.
No. What are we? Which topic are we in? The person asking, which topic are we in? We are in which topic? Consolidation. Consolidation is to add.
Add up.
Now you are adding a negative and a positive. Hello. You are adding a negative and a positive. Is that okay? To consolidate, a negative and a positive is a negative. The second point, the negative amount is more than the positive amount. So if, for example, you have negative 10,000 and you have positive 6,000, if you have negative 10,000 and positive 6,000, if you add the two, what will you get? Negative 4,000. Is that okay? You will get negative, if you take negative 10,000, to it you add positive 6,000. What if you consolidate, in other words, to add? If you add the two, what do we get? We get negative 4,000. Am I clear?
Yes. Sir.
Yes.
Can I help him to understand this?
Yes.
Or if you can use another format to make this balance.
I know what is confusing, but I'm avoiding that. If I do that, it will confuse more people. You know, being a lecturer is not easy. You try to balance interest. If I do what he wants, it will confuse more people. Okay, let me do what he wants. He wants me to write that, and then he wants me this 2,397 200. Is
and
that
you
okay?
add interest received.
Okay, let me just go step by step so that I explain what he wants. So, like that. But you see, the reason why I'm avoiding that is because I will share this Excel with you. Now, if I share this Excel with you, look at this. If I take sales, and then again I minus cost of sales,
which is
it will be illogical. Do you see it's not logical? Because I had already put negative sign there. How do you get gross profit? Gross profit is sales minus cost of sales. So if I leave this as minus here, and then I come here and I take sales minus, it changes to a positive. That will be wrong accounting. So to save many people majority, I will not write this as negative, but I will account for it when I'm coming here is when I will take, I will not write this as a 2,397 200. I will write it as a positive, but when I come here is when I will minus it. I will take this minus that. Is that okay? To give you one. However, if you do the way what is confusing, if we do this way, 2,397 200 negative, if I come here, I'll be forced to take these sales, but I add. I add the cost of sales. Now, when somebody is revising, he will click this cell, and then he sees I've added, he will ask, do we always add cost of sales to sales, or do we minus? Do you see where the question will be?
Yeah.
That is why I don't do that. Whenever I'm teaching, I'm looking at to the best interest of the majority, what majority can understand. Because now when I share with you this spreadsheet, and then you click there, you will see here, can you see the sign here? You will see there it's to add. And then somebody will ask, we were adding cost of sales to sales. It is not right. Now, do you see how the way balancing interest is not easy? Again, time is moving. Let's move on. Yeah? I hope you've understood why I've done that. Let's go to income tax. Income tax is 156,000 plus 31,200. 156,000 plus 9/12 times 31,200. You see again here, where is it? 156 here in the statement, it's negative. But when I'm writing it here, I write it as positive. Why do I write it as positive? Because I will need to deduct it. So that is 156 6, but you see that explanation confuses more people than helping. 9 divided by 12 times 31,200. Now you see here, when I'm projecting it here, I'm projecting it as positive. But now when I come here, I will take 695 and then I minus the 1. So that when you are following, you know income tax should be minus. Sorry, we have taken a lot of time in that question, but it was for a worthy cause. So let's finalize it. So what is our total profit for the year? 516. It is 516. What is our non-controlling interest? I'll have to calculate it. Look at this. What is our non-controlling interest? You take this profit of 156, profit for the year of 156. Do you see profit for the year? This one, profit for the year of the subsidiary, 156. I want to get non-controlling interest, 156
times 20%
minus unrealized profit. You remember the unrealized profit between intercompany?
Yeah, sure.
Where is it?
Working number.
Working for?
Yeah.
Working for 26,000 minus 26,000. Working for, and then times 20. I hope it's 20%. Was it 20%? Non-controlling?
Yes, it's 20.
Yeah, 20 minus. Now, there is a question that somebody had asked me in class last time, and I told you that I will answer it here. Now, it is who sold to the other. Who sold to the other? Parent sold to the subsidiary. But now the question you are asking now here, whether it is the parent who sells to the subsidiary or it is a subsidiary who sells to the parent, unrealized profit must be deducted from non-controlling interest, because it is only unrealized because it was a transaction between the parent and the subsidiary. Because it was a transaction between the parent and the subsidiary. So this will give you 156,000 minus 26,000 times 20%. What goes to the parent? What goes to the parent?
Sir.
Yes.
Here it means whether the parent is selling to the subsidiary or subsidiary is selling, we always take this non-controlling from.
Yes. But I will show you where it is different. When we are eliminating it from the retained earnings, it will be something different. I will explain. I just want to go step by step. Is that okay? When we are calculating retained earnings, it will be different. Is that okay?
It's okay.
Okay, fine. So let's move on, please. So this gives you 5 minus 26. Why is it 26? Did I do the right thing? Oh, it happens by coincidence. It's also 26. Huh? You can see this. It gives you 26. Oh, sorry. How much is it? I'm just redoing it. 156,000. I'm just confirming that it is 26. Minus that, close the bracket times 20%. Does it give you? Yes, 26. Now, movement on retained earnings.
Excuse me, sir.
Yes.
49 over 12.
For non-controlling interest, aren't you going to multiply by post-acquisition debt for nine months of post-acquisition?
Let me ask another question to answer that. When did the transaction take place? Post or pre? This is intercompany sales. When did it take place? After acquisition or before?
Post acquisition.
Post acquisition. So all this profit is for the post period. Why do we always multiply by 9 over 12? If there is a transaction that happened in the whole year, not post, in the whole year. Have I answered you?
Yes.
Okay, thank you.
Excuse me, sir.
Yes.
The statement I want to be, I want you to be cleared. You say that if there is analyzed profit, always it should have to be limited on subsidiary.
No, I've not said on subsidiary. I've said on non-controlling interest.
Yeah, sure, non-controlling interest.
Yes, on non-controlling interest. That is true.
Okay.
Yes. Okay, fine. Let's finalize this. Now, what was the retained earnings? Do you see this statement? GL's opening retained earnings were 859,300, and Ngonga Limited's were 280. Opening. Are we interested in the profit of the Ngonga? Opening? No.
No.
Why are we not interested? You remember explanation I gave in the other question? Because this profit was made before we acquired Ngonga. Remember, Ngonga was acquired during the year. So this profit at the beginning, opening retained earnings, is not our profit. Why is it not our profit? It is profit that was made before we acquired Ngonga. I hope we are together. So we only take 859,300. 859,300. So where am I? Here. 859,300. Why have I not taken the one of the subsidiary? Because subsidiary was acquired after. What is the profit for the year? The one that goes to the parent is 490. What is our profit carried forward? Plus that. That brings us to the end of consolidated income statement.
Please, sir. Sorry, sir.
Yes.
On this 156 of Ngonga Limited in profit for the year, why could we not calculate at 9 months before you deduct?
You are right. Thank you. You are very right. I made a mistake there. Where is it? Where did I apply it? Thank you. You are very correct. You see, I was not supposed to be picking 156. I was only supposed to be picking 9 over 12 of 156. Don't confuse this with the statement I made earlier of intercompany. Intercompany sales was after acquisition. But this profit of 156 was for the whole year. 156 is both for pre and post. So where did I apply it? Somebody to remind me.
That's non-controlling interest.
Non-controlling interest.
Yes, here. So it should be
156.
Like that, huh? You understand me there?
Yeah.
Okay. So here it will change to, let's be careful what I'm doing. 9 over 12 times 156. Thank you for that reminder. Minus now Bodmas becomes a problem here. Minus 120. Let me do it separately here.
Minus 26.
But I'll still need to multiply by 20%. Do you understand me? Look at this. I'll need to multiply by 20%. So I'll take 9 over 12 times 156,000 I hope we are together, minus 26. Do you agree? That is the whole profit of the subsidiary. And then you take this answer times 20%. Does it make sense?
Yeah, sure.
Yeah, okay.
It is now clear.
It is now clear. Okay, thank you. And that brings us to the end of consolidated income statement. The only income statement that is remaining, let me be very clear, is when there is an associate. But that one, I will teach it together with the balance sheet when I'm covering associates as a topic.
I have a problem, sir.
Yes.
Still on the non-controlling interest.
Yes.
You have forgotten to apply 20% because what is not controllable, it is not the whole amount. It's not the total of 9 out of 12.
We have applied. Look here. What 91? Don't confuse. We have not used 91. What have we used? 18,200. What is 18,200? It is 20% of 91.
But because you didn't write it there, that's what I'm saying. It is not written there. Thank you.
Here. It is written. Do you see the 20? When you click this cell, what do you see? It is 20%. Unless I'm not understanding you.
It is now clear for the non-controlling interest.
Now I've clicked cells until now I'm confused. Is it okay?
Yes.
We are 18,200 is 20% of 91,000. Okay, let me write for you here. 18,200. Okay, how can I write it? 91,000 times 20% is equals to 18,200. Is that okay? Let's talk.
Sir. And then the profit attributable to parent should be changed in the figure, balance figure.
Yeah. No, it is a balance. It's a formula. It has not changed.
Yeah, it is a formula.
Yes.
Yes.
Has been changed.
Automatically.
It has been changed. Yes, yes. Okay. I have seen it.
But in your exams, remember to change it. You don't have a Excel in exams. Okay. Any other question? Let's have
operating expense. Operating expense. We get 15,600.
Here. The goodwill was reviewed for impairment at the end of the reporting period and has suffered an impairment of 15,600, which is to be treated as an operating expense.
Okay, thank you so much.
Okay. Can we have a break of 15 minutes? We will continue at 10:30, but I advise you so that you don't waste our 5 minutes admitting people. Please don't log out. Just assume the class is continuing. Is that okay? Don't log out, because when you log out, I'll be forced to again admit, and you are very many. Is that okay?
It's okay.
It's okay.
Let's have a break of 15 minutes. We meet at exactly 10:30. We are starting consolidated balance sheet at 10:30. Thank you. Let's have a break.
Leave the Excel open so that we can write the answer.
Okay, fine. But you see now, those who are not in class, we may think we have ended the class. At break time, I always want to leave a slide that shows that we are in break. Okay, but it's okay. Let me leave it open.
You can share it in the group.
Yeah, there, it's okay.
Okay. Tell people we are in a break. so that they don't think that we have muted.
But the Excel sheet will be shared at the end of the class.
Yes, I will
Yes.
share it.
Thank you.
Of course.